Chapter 9 is on depreciation and depreciation methods. There will be a series of 3 voiceovers for this PowerPoint. The first one we're going to talk about are what are long-lived assets, and we'll talk about the cost principle, and we'll start talking a little bit about how depreciation is handled, the accounts used, how it shows up in the balance sheet. But in the next PowerPoint voiceover, we'll be talking more about the depreciation methods that can be used, because a company has a choice in which depreciation method to use. It's interesting because when we talk about accounting, the common thinking is that, well, there's one way to do the financial statements, and if the financial statements aren't done that way, then they're wrong. The company is just in error, or they're committing fraud. But actually there are many different ways to handle several of these issues, and depreciation is one of those where a company gets to decide. Inventory is another area where a company got to decide. Then we'll talk about impairment and disposing of these long-term assets in the third voiceover. These long-lived assets also have other names. The other names include property, plant, and equipment, and it's sometimes abbreviated or used by the acronym PPE, PP&E, and they're also called fixed assets. But to be in this classification, they have to be actively used in operations. So if a company were to buy something that is a long-lived asset that's not going to be used up within the next year, say it's an automobile, when they purchase this automobile, if they're not going to start using the automobile in the next year, it would be an investment. If they start using it in the next year, then it's classified as property, plant, and equipment, or fixed asset. So it has to be actively used in operations to be in this classification, and it has to be something that's not going to be consumed or used up in the next year, and therefore it's long-lived. It has a life that goes on. There are 2 categories below this then. Tangible things are things that you can physically see or touch. For example, your equipment, your building, your land. It has a physical substance. There are also intangible things that do not have a physical substance, and we will talk a little bit more about those. But think of copyright, for example, or trademarks. These are things that will not be used up in the near future. They will be used up over a longer period of time, so they're long-lived assets. But they don't have a physical substance. You may be able to, yes, go back and look at a document that points to the legal or contractual arrangement for a trademark or a copyright. But the value of the thing transcends that paper document. It goes beyond that paper document. And so we say it doesn't have the physical substance that, say, equipment or land or building has. Its value is something more than that paper document. We call these things intangibles. So tangibles would be land, and another thing to note about land is there's no depreciation taken on land. Almost all the other examples that I can think of for PP&E that are tangible, you do take depreciation on. And you will get to choose the methods for that. Intangible, in contrast to depreciation, we usually call this amortization, because we recognize at some point in time a trademark will lose its value. A patent will no longer have value. And we figure out at what point they do not have value, and this is a period in which we will amortize it off. Now, if your trademark is something that has an unlimited or indefinite life, then you do not amortize it, because there's no end in sight. It will continue to have value forever. You don't amortize it. So trademarks tend not to be amortized. However, if you know the trademark is no longer going to have value at a certain point in time, and then you can say it has a limited life, you would amortize it. Now, under the cost principle, whenever we purchase something, we put everything that gets it into a condition for use into that asset account. When we had inventory and we said the inventory wasn't in a state where it could be sold, and we needed to have maybe an article of clothing needed to be cleaned, we capitalized the cost of cleaning it when we put it in inventory. The same thing happens with PP&E. We have the price we pay for the thing, but then we also have any type of expenditure to get it into a situation where it can be used. These are capitalized. So we capitalized freight, and with inventory, we're going to capitalize freight charges here. There are differences, though, between this and inventory, and one being that since this is a long life asset, we may have to have it installed into our location. It might be equipment that would be installed in a factory. Well, anything to get it into a usable condition is capitalized, so those installation charges would be capitalized. So they get included in the price. For example, with land, if you have to have a survey or a title search done in order to acquire it because you're going to pay for it with a mortgage, say, well, those things can be capitalized. With buildings, let's say you're going to build a building. You need to have the architect come in and look at the building and come up with an appraisal of what needs to be done. All that is capitalized because you have to have these things done to use the building, to have the building in the end so that you can use it. Again, all these things have to be used in your business immediately, or they don't qualify as PP&E. Equipment. Sales taxes, by the way, are also capitalized. I talked about installation. Any freight charges associated with it are also capitalized. If you have something that you're purchasing and it's a combination purchase, you're going to purchase a land with the building, and some of you maybe are buying your house, and you're buying your house and also the lot on which the house stands. Well, if this were a business, the business would have to divide the value that they're paying, the total amount paid, into land and building. And to do this, then you need to figure out what the appraised value is of each one of the items separately. Why do we have to do this? Because we could later demolish the building and then we'd have the land left, and we'd need to take the building off our books when it was demolished. Land does not get depreciated, but the building will be depreciated. And so we have to have them in separate accounts. Even though when we look at the financial statement, oftentimes you'll see land and building combined into one account. For our accounting purposes, to handle the accounts, we need to separate those. We need to put them in separate accounts. So on January 1st, we have Jones purchasing land and building and paying $400,000. Now notice the appraised value of the two items separately, $325,000 plus $175,000 adds up to $500,000. So really, Jones, in buying these things separately together in one lump purchase, did better than buying it separately, because if they'd bought the two separately, the value would have been greater. So it's a bargain for them to pay $400,000 versus $500,000. But we're going to still use the appraised values because we need to use these appraised values to split the $400,000 in between building and land. Again, land is not going to be depreciated. So to do this, we look at the appraised values and we see that the total appraised value is $500,000. Now the 35% that is calculated here is 175 divided by the 500. The 65% is 325 over 500. So roughly 35% of the value of the 400,000 needs to be put into the land account, and 65% needs to go into the building account. So when we would have done that journal entry, we would have credited our cash for the actual amount we paid, and we would have debited land and debited building according to that schedule. And the total amount, because we multiplied by that percentage, will add up to the 400,000. Here we have another problem where we have Cedar Fair purchasing a ride for $26 million less a discount. They paid $125,000 for transportation and $625,000 for installation. So what we have to do when we come to a problem like this, and we have to ask ourselves, what are the necessary amounts which we paid to use this new ride, to get this new ride in a condition where it can be used? So I'm assuming Cedar Fair is an amusement park. They did not pay $1 million. That is a discount. Because it's a discount, they did not pay it. If you don't pay it, you cannot capitalize it. So the $1 million is taken off the invoice value to get $25 million. Transportation and installation costs are capitalized, and the ending value is $25,750,000. So when we record this, it will be recorded as a purchase of equipment for $25,750,000. If you paid for it partially with cash, you credit the cash amount. This is the actual cash paid. And then you're also going to credit a note because they are going to pay with it with a promise to pay of $25 million. We have a later chapter, and we'll be talking further about notes and liabilities and how they are recorded. For now, you need to think of the value of the equipment being right at $25,750,000, and think about the actual cash which flowed from this company to the supplier of this ride, and that was $750,000. And the fact that in the future they're going to have to pay off a $25 million note. In addition to these amounts which are paid to get this asset to its location and useful condition, we also can capitalize large infrequent expenditures expenditures that extend the useful life or increase or improve productivity or efficiency. And let's talk about some examples of this then. Over here I talk about putting a new engine in a truck. A new engine in a truck is necessary so that the truck can continuously be used, or it can be used in providing, say, delivery service. So it is a necessary expenditure, and yes, an engine would be considered a major expenditure. That thing would be capitalized. The tires on this truck would also be capitalized, and they would probably be depreciated over their useful life, and the tires on the truck will not last as long as the truck itself, so we will probably capitalize those and put them in a separate account. If you had a manufacturing plant and you had a machine which was working and it was working fine, but you found that it could produce more units of output if you made a small change to it. So you're going to make a change to it, you're going to make a modification to it. All the cost associated with modifying that machine, including installing this new component of the machine, would be capitalized. If this was something that's major in value, then it is capitalized. Now, ordinary repairs and maintenance, you just take those to expense. So, let's say you have the oil changed on the truck. That doesn't really extend the useful life. It's something that you would typically do with an automobile. We all should be getting our oil changed. We also should probably rotate the the tires to the truck. This is something that is ordinary and expected. And it is expected that we do these things so that the tires or the truck engine lasts to the time that it's originally expected to last. So therefore we call these things expenses. Companies oftentimes try to manipulate their income statement by not recording expenses. Instead of doing this recording of expenses, they try to capitalize or put them in assets. This is not GAAP. Clearly, GAAP says there's differences between when you expense an item and when you capitalize the item. Depreciation expense is something which we will be doing on almost all of these tangible, long-lived assets except for land. And it is a cost allocation process. So we take on this asset and we record it by debiting the asset, but we know that at a certain point in time the asset's not really going to have value to the company. If you had a fleet of delivery vehicles, let's say the cost of those was $500,000, and they were pickup trucks. Well, you know that if you initially showed it as $500,000 on your balance sheet, 5 years from that date, it wouldn't be right for us to still show $500,000 as our value of those fleet of trucks, because their value would have gone down. Now, the balance sheet is not about looking at the appraised value of a thing, but it's thinking about, well, what is it likely to be worth in the future? And it's about allocating the costs today to the appropriate income statement periods for that asset. So what we're trying to accomplish is two things. We're trying to allocate the cost of these assets into the income statement over future time periods. And we're also trying to systematically reduce the value of the fleet of trucks, so the reader is not going to look at it, the balance sheet, and think, well, this means they've got a lot of new vehicles, because it would be it would be fraudulent for us to show our balance sheet as if those trucks were all new when they are 5 years old. So we're accomplishing two things. We're getting the balance sheet to a more reasonable state, and we are allocating the cost to the income statement. And oftentimes we don't even talk about the balance sheet because we don't want the reader to assume the balance sheet is market values of anything. It tends to show cost, acquisition cost, plus any other capitalized costs such as buying new tires, replacing an engine. But this expense, what it is depreciation expense. And depreciation expense will show up on the income statement. Now, instead of doing a credit to that automobile account or that specific long-lived asset account, we are going to be crediting an account which is a contra account, and it is accumulated depreciation. It shows up on the balance sheet, and it is like a holding bucket that accumulates all the depreciation expense that this asset has ever had. So if we were to record depreciation and it's $130 for a particular asset, They don't tell us which asset it is, but it's being depreciated $130. The next PowerPoint is going to talk about how we come up with the number. For this voiceover, let's just think of it as given, $130. When we record this, we are going to be recording depreciation expense, which is negative stockholders' equity because it reduces retained earnings, because it reduces net income. And we are going to be crediting an asset account, or as you see here, we will be increasing the contra, increasing a contra, reducing an asset account for the same amount. Expenses tend to be debits, so depreciation expense is debited and the credit is to accumulated depreciation. When we get to this depreciation expense number, we need to know how much we are going to take off over the life of the asset. We need to know what amount we should have at the end when we stop using the asset. And this is sometimes called residual value. It is oftentimes salvage value. And salvage value means, well, we've stopped using this vehicle. It's no longer reliable for us to use this for deliveries. We may not get the pizza to the customer. We may lose sales. So we want a reliable vehicle. What are we going to do at the end of the time period when we stop using this asset, this delivery truck? Well, that is the residual value, the calculation of what we are going to sell the asset for at the end. When we do this depreciation, you see we are doing it far in advance of getting rid of the asset. So when we first acquire the asset, at that point, we need to determine what are all the costs to get it into a useful condition and location. So that's our initial acquisition cost. We need to figure out how long we expect to use it. It's really reasonable to assume that a delivery truck might be used for 5 years. Doesn't have to be 5 years. It depends upon the policies of the company how long they're going to use the delivery truck. And they have to determine this when they acquire that asset. And then lastly, they need to figure out when they stop using it what they expect in the future to sell it for. So 2 and 3 are estimates. Are they going to be exact? No. It is unlikely that they will be exact. Sometimes you'll start using a vehicle and you'll find out that it just doesn't seem to be dying. It's going forever. Some of you may be driving vehicles that have over 200,000 miles on them. This happens for businesses as well. They expect it not to last, and it lasts, and that's a wonderful thing. And also the residual value. Sometimes we have an asset and we decide to get rid of it, and we don't like it. It's not working out for us. And so we get rid of it before we have taken all the depreciation on the vehicle, and our estimate then of residual value that we initially made is wrong. These are estimates. We aren't expected to be precise. They are estimates. All companies have to come up with these numbers, though. When they acquire assets, they need to be depreciated because we have to set up these depreciation entries need to be done every time we do financial statements. So when we do our financial statement, it shows up generally as an operating expense as depreciation for this time period. And it would be depreciation on all the assets that are tangible, long-living assets that are depreciated. When we show it on our balance sheet, we are going to show it as a contra. So since property, plant, and equipment is a debit balance, accumulated depreciation would have a credit balance. It is subtracted because it's the contra account that's associated with property, plant, and equipment. And this value also is a balance sheet value that accumulates. Notice up here on the income statement, our depreciation expense only reflects the depreciation expense for this particular time period. This accumulated depreciation is an accumulation of depreciation over the life since the beginning when we first started taking depreciation on this asset. This 1,250,000, I'm assuming, well, I suppose it's 1 billion because it says up here it's in million. 1,250,000,000 in accumulated depreciation is all of this depreciation since the beginning when they first acquired these assets. It also does, though, include the 125 million, which is for this year. The net of these two is often called book value. Book value. It's going to be important that you understand what book value is when we talk about removing these assets from our books, when we get rid of the assets, whether we retire them, whether we sell them. It's important that we know what book value is. So book value is cost minus depreciation, accumulated depreciation. That's called book value. And it's also sometimes referred to as a net property, plant, and equipment value. Now, the depreciation methods will be the topic of our next PowerPoint.